So good morning, ladies and gentlemen. Welcome to our meeting after the monetary policy session of the Bank Board. I'm very pleased to welcome Vice Governor Mr. Vladimír Tomšík, who is definitely willing to answer all your questions after the opening presentation. And I also welcome Mr. Tomáš Holub, who is Director of the Monetary Policy Session. So please, I would like to ask Tomáš for the opening presentation. Thank you.
Good morning, ladies and gentlemen, dear colleagues. As always, it's my big pleasure to present to you our new macroeconomic forecast. I will start with briefly summarizing the key assumptions of this forecast. Then I'll go into its detail, and at the end I will compare the forecast to the previous one, trying to highlight the major forecast revisions. So starting with the assumptions, as usual, our forecast is significantly affected by the assumptions about developments in the effective trade-weighted euro area. The outlook is relatively optimistic in the sense that GDP growth will stay around 2% over the entire forecast horizon, and this is basically unchanged compared to the previous forecast. Nevertheless, if you look at the assumptions about price developments abroad, you can see that we now assume that the decline in euro area producer prices will fade away later than originally assumed. In particular, it will turn back into positive numbers only at the end of this year, and it is of course very closely linked to the further drop of oil prices that has taken place in the global commodity markets. There are also some changes in the outlook of monetary variables in the euro area, which are related to the further extension of accommodative monetary policy by the European Central Bank in December last year. And as a result, the outlook of 3 months Euribor is now negative until the very end of 2017, and a slight further depreciation of euro against the US dollar is expected. On top of what you can see here, we also incorporated into the forecast the extension of quantitative easing in the euro area at least until March 2017, which may of course have some implications on the domestic monetary policy and exchange rate developments after the assumed exit from our exchange rate commitment. As regards fiscal policy, our estimate of last year budget deficit is at 1.3% of GDP, which is a decline compared to 2014, enabled by fast economic growth last year, coupled with dissipation of some one-off extraordinary effects, which increased the deficit in 2014. And we expect further declines in the budget deficit in the coming 2 years. And in fact, we assume that in 2017, the budget will be close to balance. In 2016, the decline in budget deficit will be due to a fall in co-financing of EU funds, increase tobacco excise duties, which will more or less offset the impact of a one-off increase in pensions. There are also some measures to improve VAT collections, which are taken into account, and we expect lower debt service cost of the government. In 2017, the further decline will be also driven by ongoing economic growth and a further decline in debt service. And moreover, we assume that the one-off measures from 2016 will fade out. At the same time, I must admit that as usual, we don't take into account any potential impact from the political cycle, which may create some incentive for higher government spending in 2017. Regarding the impact of fiscal policy on the GDP growth, our assessment is such that it was quite significantly expansionary in 2015, mainly because a spike in government investment financed by EU money. But as the new program period is starting only gradually, this will actually lead to a restrictive impact of fiscal policy on economic growth in 2016. And we estimate the overall negative fiscal impulse for this year at minus 0.6% of GDP. In 2017, with already growing public investment financed by EU funds, there will be a marginally positive fiscal impulse. As a new addition to our forecasting toolbox, we are now using publicly available data on investment type public procurement as a leading indicator of public investment. And this data really suggests that after the peak in government investment at the end of last year related to the end of the previous programming period, there may be really a significant temporary drop in public investment, especially during the first half of this year. And we incorporated this into our forecast. As regards monetary policy assumptions, we kept the assumption of all the forecasts from 2015 that monetary policy interest rates as well as market interest rates will be flat at their current very low levels, and that the exchange rate will be used as a monetary policy instrument with the exchange rate commitment set at 27 korunas per euro until the end of 2016. After the exit from the exchange rate commitment, the forecast is consistent with an increase in market interest rates, and I will talk about it later. We are still of the view that the exit should not lead to an abrupt, sharp appreciation of koruna to the slightly overvalued level before we started intervening in November 2013, because the weaker exchange rate is in the meantime passing into wages, prices, and other nominal variables, even though it's not so easy to see this impact against the background of overall very low inflation. Nevertheless, the forecast is also affected by the extension of the quantitative easing by the European Central Bank and its impact on a positive interest rate differential after the assumed exit, which of course are factors which might work towards some appreciation of the currency after the exit, together with renewed real convergence of the Czech economy to the advanced euro area countries, even though the speed of this convergence will of course be much slower than in the pre-crisis period. On the other hand, the forecast does not explicitly take into account that any appreciation of koruna might be actually moderated by hedging of exporters ahead of the exit and by closing of long koruna positions by financial investors and also possible FX interventions of the Czech National Bank to mitigate exchange rate volatility. And as you might have noticed from the board statement, the board is putting an important weight on those potential factors mitigating any future exchange rate appreciation. Now let me go to the forecast itself. First, just a brief summary. We expect that headline and monetary policy relevant inflation will start increasing from the current levels close to zero, and they will hit the 2% target at the monetary policy horizon, which at the moment it's the first half of 2017, and then they will be moving slightly above the target. The increase in inflation will reflect, first of all, fading out of some anti-inflationary shocks that are driving inflation so low at the moment, so fading out of the low oil price impact, the temporarily halt in the growth of food prices, etc. And also by the fundamental story from the Czech economy. We see that the economic activity continues to grow, and for this year we expect a further and relatively noticeable acceleration in nominal wage growth in the business sector, and this will of course bolster further growth in costs and consequently also consumer prices. And at the same time, the currently very strong anti-inflationary effect of import prices will moderate. In terms of the GDP growth forecast, we expect a slowdown from 4.7% last year by 2 percentage points, which means to 2.7 this year, because of a temporary decline in fixed or in total investment, mainly due to a drop in public investment financed by EU funds. And for 2017, we expect a slight pickup of growth to 3%. Together with the ongoing economic growth, we also expect continued growth in employment, albeit at a somewhat slower pace than what we observed last year. And I already mentioned an expected acceleration in nominal wage growth. So this is the fan chart for our headline inflation forecast. You know that at the end of last year it dropped to 0.1% only because the food price growth stopped and the fall in fuel prices deepened further. But we actually expect inflation to return to somewhat higher levels already at the beginning of 2016. There are some leading indicators which suggest that food price growth will resume already in January, and because of base effects, the drop in fuel prices will be moderating in year-on-year terms, even though the absolute level of fuel prices has kept declining, of course, because of the further drop in global oil prices. And as I mentioned, at the monetary policy horizon, we'll reach the 2% target and then move slightly above it. The monetary policy relevant inflation, which excludes primary effects of indirect tax changes, is lower than the headline inflation forecast, but the difference is small. It's just 1 or 2/10 of a percentage points, reflecting further increases in excise duties on tobacco. And as a result, the monetary policy inflation will be close to the 2% target from mid-2017. Looking at the current structure of inflation, it's really quite diversified. We see a significant drop in fuel prices, and in December there was actually also a decline in food prices. And on the other hand, we have a persistently positive contribution from core inflation, which is gradually picking up. It reached 1.4% in December, and the slight acceleration reflects the development of both tradable and non-tradable prices. And we interpret this as a reflection of some inflationary pressures from the domestic economy, which are already strong enough to more than offset the still very anti-inflationary foreign environment. In terms of core inflation, of course, not in terms of the overall headline inflation. Going forward, first we assume that administered prices will continue to decline marginally also in 2016 after their small decrease in 2015, and this will mainly reflect a decrease in natural prices for households. In 2017, we expect growth of administered prices marginally above 1%, with positive contribution of most administrative price items, except of electricity, where we expect some decline. As regards net inflation, the measure of market-determined prices, we expect an acceleration. Initially, it will be mainly due to fading out or some, I would say, some base effects, but later on it will be reflecting the fundamental story of the Czech economy, with further increases in core inflation and renewed growth in domestic food prices. Here you can see the forecast of core inflation, or as we call it, adjusted inflation excluding fuels. We expect that by the end of this year it will accelerate to 1.7% and then increase further in 2017 toward 2%. And the main factors will be a robust growth in domestic economy, accelerating nominal wage growth, and unwinding of the drop in foreign prices. As regards food prices, I already mentioned that we expect renewed positive year-on-year growth already at the beginning of this year. Also looking at some leading indicators of food prices in the near term, and then as the one-off effects which kept food prices low in 2015 will fade out, we expect food price growth to accelerate towards 3% year-on-year at the end of 2016 and during 2017. Looking at the underlying inflationary pressures in the economy as identified by our co-projection model G3, what we see now is that nominal marginal costs in the economy have been more or less stable, flat, stagnating for about 5 quarters in a row, because the the domestic pro-inflationary pressures which have started to emerge and which are shown by the yellow bars have been fully offset by the negative red bars, which is the anti-inflationary effect of import prices. But going forward, this anti-inflationary effect of import prices will be diminishing, and there will be some further increase in the domestic cost pressures because of mainly acceleration in nominal wage growth, and as a result, the overall growth in nominal marginal costs in the economy will revive, and this will be contributing to the return of inflation back to our 2% target. This is the GDP fan chart. As I mentioned, overall we assume that last year growth reached 4.7%, and this was supported by easy monetary conditions, a sharp rise in government investment, mainly financed by EU money, growing external demand, as well as low oil prices, which, according to some our analysis, added at least 1 percentage point to the GDP growth last year. This year, there will be a sharp drop in government investment financed by the EU money, as I already told to you, and this will lead to a significant slowdown in the economic growth, in spite of the fact that the other tailwinds for the economy will still be in place. So monetary policy will remain easy. We assume ongoing growth in foreign demand, and the further drop in oil prices mean that there will be some further positive impact also from the commodity prices. As regards the individual components of aggregate demand, you can see that for 2016, and especially the second half of it, we anticipate some further acceleration in household consumption growth because of growing nominal wages, a speed up in nominal wage growth, and some further positive boost from low oil prices in terms of their supportive effect on real incomes. On the other hand, we expect a temporary decline in investment in 2016 because of the drop in EU-financed projects and also some negative contribution of inventories. I'll show you a detailed decomposition of this on the next slide. In terms of exports and imports, we expect that they will continue to grow mostly in the range of 7 to 8%, with a slightly positive contribution of net exports to the GDP growth in 2016 and a slightly negative one in 2017. This is a detailed decomposition of our projection of gross capital formation. So you can see that last year there were positive contributions from increasing private investment, but even a bigger part of the growth was due to a sharp increase in public investment financed by EU funds. And on top of that, some accounting effect of prolonged lease of Gripen supersonic fighters in the fourth quarter of last year. And inventories were adding to growth quite significantly in the first half of 2015. Now for 2016, we expect a drop in public investment because of only a gradual start of the new EU program period, some decline in inventories in year-on-year comparison, especially in the first half of the year, because of course the base effects will be quite strong, and of course also a base effect of the grip and fighters at the end of 2016. On the other hand, we are quite optimistic as regards private investment, which is showed by the red bars in this chart. We expect some further acceleration of private investment because of ongoing growth of both foreign and domestic demand, and already quite high capacity utilization in the domestic economy. As regards labor market developments, the employment growth in terms of full-time job equivalents reached 1.5% in the third quarter of last year, and it was driven purely by increasing number of employees, while the average hours worked per employee actually declined slightly. We expect some moderation of employment growth going forward because, well, we have more or less approached full employment, and of course it will not be as easy as before for companies to hire new people, and the growing demand for labor will be manifesting itself more strongly via higher nominal wage dynamics, which you can see here. We expect that after an increase by 3.5% last year, wages will grow slightly above 5% both in 2016 and 2017. And the unemployment rate will decline a bit further, but not too much. Actually, we got new figures for the fourth quarter of last year after we finalized our new forecast, and in seasonally adjusted terms, it reached 4.6%, slightly by 1%, by 1/10 of a percentage point below our forecast. And then we expect that unemployment rate will decline to 4.4% in the middle of this year, and more or less stabilize there, because the ongoing growth in employment will be more or less fully matched by growing labor supply, or the labor force. As I said at the beginning of my presentation, the forecast assumes that the market interest rates will be flat at the current very low levels until the end of 2016, and then with the assumed exit from the exchange rate commitment at the beginning of 2017, there will be an increase in interest rates. Of course, here it is still true what I said last time. In the forecast, we don't incorporate any kind of strategic monetary policy considerations. The fact that in practice the exit from the exchange rate commitment will probably come sooner than the first interest rate hike. In the forecast, we really assume technically that the two things will come at the same time. Finally, let me briefly compare the current forecast with the previous one. The most visible change concerns the inflation projection, which is lower on the whole forecast horizon, but most importantly for the next 3 quarters. On the other hand, we have quite negligible revisions of the GDP forecast, a relatively small upward shift in nominal wage growth trajectory, and the same assumptions about the exit from the exchange rate commitment as in the previous forecast, but a smaller increase of interest rates after the exit, which reflects mainly easier monetary policy assumed in the euro area for 2017, and mainly the extension of the QE by the European Central Bank. So here you can see the downward shift in the inflation forecast, which of course reflects the carryover effect of the observed lower net inflation at the end of last year. And it's also lower for the next few quarters, while the administered prices, as you can see here, are slightly higher, but the impact is really very small on the overall projection. The lower forecast of net inflation, it reflects the unexpected halt in food price growth at the end of 2015, and of course, the longer lasting and deeper anti-inflationary effect of foreign producer prices, including a further decline in global oil prices. On the other hand, the fundamental upward pressures from the domestic economy will become slightly stronger than we assessed in the previous forecast due to somewhat faster growth in domestic nominal wages, and this will enable the net inflation to gradually converge towards the previous forecast. In terms of the breakdown of the net inflation forecast, core inflation at the end of last year, and also as we expect at the beginning of this year, was above the previous forecast, but then the new forecast is still increasing, but at a slower pace than the previous one, so it gradually gets below the previous projection because of the more pronounced anti-inflationary effects of import prices. And on the other hand, for food prices, we expect much lower growth in the coming quarters as a carryover effects of the downward surprise at the end of 2015, but as some of the one-off effects fade out, we actually have a higher projection for 2017. The GDP growth changed negligibly, so I'll skip this slide. Maybe I'll add that we are now more pessimistic about government investment in 2016. The new forecast has a deeper drop in public investment financed by EU money, but this negative effect was more or less fully offset by a positive supply side effect of the previously unanticipated decline in oil prices. You can see some more visible changes as regards the structure of economic growth. We expect that the lower oil prices and lower inflation combined with somewhat higher nominal wage growth will lead to higher consumption growth this year. And on the other hand, as I mentioned, we moved our investment projection for this year from slightly positive to slightly negative growth rates because we reflected the data on public procurement suggesting a deeper drop in public investment. Here we have somewhat higher nominal wage growth, reflecting mainly the upward surprises in the second half of 2015. And the last chart shows a milder increase of domestic market interest rates after the assumed exit from our exchange rate commitment. As I've already said, this reflects mainly the more and longer lasting easy monetary policy by the European Central Bank. And that's it. Thank you very much for your attention, and I pass back the floor back to Marek Zeman.
Thank you, Tomáš, for your presentation. Now it's the time for your questions. So please first give us your name and your company and switch your mic before you will ask the question. Thank you. Please. Can you switch the mic, please?
Good morning. My name is Yun Ruchen, Economic Council of the Chinese Embassy. My question is on page number 8. What's the main reason for the sharp contrast of the food prices? You see in 2015 it's even negative. So what's the main reason for the sharp decrease and increase? Thank you.
Just
probably let me interrupt a bit. First of all, I would like to say, I would like to welcome all of you to the Czech National Bank, and I would like to say good morning, everybody. And why I'm just interrupt, because I think it makes sense to collect like 2 and 3 questions, in one round, and probably it will allow us to put 2 or 3 questions, a little bit together, and probably to answer more of them. So, and back to your question. If there is a technical questions, I think that Tomáš Holub, head of the department, he's the right person to, answer it in more details, and I, as a vice governor, I will be here to answer some more policy-oriented questions. So, but nevertheless, we got questions regarding the food prices, and let me ask you if there is some more questions in the first round. If not, Tomáš, the floor is yours.
Okay, thank you very much for the question. Well, what we observed in 2015 is quite diverse development of food prices if you look at the individual items. And the biggest downward contributions came mainly from milk, meat, and some other items. And there were some one-off impacts, for example, the restrictions of imports of food to Russia contributed to some excess supply of food in the EU market, and it was putting some downward pressure on food prices, mainly in those countries which are neighboring with Russia or are not too far from their borders. Another one-off effect which is temporarily slowing down food prices is a decline in milk prices related to abolishment of production quotas on milk in the European Union, etc. On the other hand, especially in the first half of the year, food prices were also affected by declining prices of major crops in the global markets. But now what we can see is that those prices have started to reverse. Overall, the agricultural producer prices are already slightly growing. But so far it has not yet been sufficiently strong to move food prices back to positive growth rates. But we are using monthly indicators from the Czech Statistical Office as well as some data collection from internet to get leading indicators of food prices at the beginning of this year. And these indicators are suggesting that food price growth should resume already in January this year. Of course, we will be curious to see the official data release because those leading indicators are never 100% reliable. But if they start to increase, it will probably be a natural reflection of the renewed growth in agriculture producer prices.
If I get probably a few sentences to this topic from the policy relevant probably decision maker, it's always difficult to predict regarding the food prices because nobody is really very good to say exactly what kind of harvest we can expect, what kind of weather we can expect. So what we do in our forecast, we always use harvest data average. Of course, if there is a good harvest, if there is some new things like sanctions, of course we are surprised. But we try our best to really put average data in our forecast and also say what kind of risk we see. So this is our explanations. And if we try to improve our forecast based on, it was clearly said by some indicators, but some data collections, it's always welcome. Yeah, but nobody can exactly say what kind of data from harvest time, what kind of data, what kind of prices from farms we can expect from next year. So do we have more questions? Second round. Helena, first one, please.
Czech National Bank is ready to mitigate Yeah, sorry. So once again, maybe, without my name, because I think everybody of you knows me. So Tomáš has mentioned in the presentation, and it's written in the presentation, that the Czech Nation Bank is ready to mitigate the currency volatility after the exit. My question is, if there is the readiness of the Czech Nation Bank to mitigate only strong appreciation, or if the Czech Nation Bank is ready to mitigate overall or too fast even depreciation. Thank you.
Thank you. So that was the first questions in the second round. Please, second question, second round.
Radomír Jáč, Generali Investments. Good morning. My question relates to the topic of negative interest rates. In your statement published yesterday, the central bank says that this topic was renewed as a debate in the board. If I take your macroeconomic forecast, I would find hardly reason for negative interest rates. As Mr. Governor admitted, it's mainly about financial market developments. So I would ask Mr. Tomšík if he could elaborate, let me say, what has to happen for you to consider option of negative interest rates as real serious option.
Thank you. So we do have two questions, and we have the final one for the second round. No more questions, no more interest. All right, so let me start with answer. The first one was regarding the volatility. And Elena, you clearly said that regarding volatility after exit. Let me just say some few words regarding the volatility. I think CNB has been always advocating to be ready to mitigate volatility, which brings uncertainty in the financial and real economy. So it's not really, I mean, after the exit or before, if we see any huge volatility, and of course we can debate what is the huge, yeah, but we are always here to do that. We have never ever said that we do have free floating in the past history. So it seems to me that we are an inflation targeter, and if we see any volatility which can, significantly affect commitment, which will significantly affect commitment regarding the, our inflation target, we are ready to do that. And now, to be more directly regarding your question, well, I think it makes sense, both sides, both volatility, even on the side of appreciation as well as depreciation, can significantly, affect your inflation target. But as I said, well, first we have to see, conditions to think about exit. And we have several times said that, we are waiting for sustainable inflation pressures coming from real economy. And so far we are very pleased that we see sustainable inflation pressures coming from domestic side. And Mr. Holo presented it quite clearly. If you look at the adjusted inflation, it means core inflation excluding full prices. We are very pleased. We see some sustainable pressures coming from, this real economy. By the way, the figure says that if you especially look at the tradable goods, in 2013, it was in -3%. Now it's +1%. You see that the commitment really helped to change the inflation in tradables from -3% to +1%. So we will be ready to think about the exit. And of course, any volatility, if it significantly, put the inflation target in threat, that we are here. Yeah. And regarding the second questions, negative interest rates. Look. Back to November 2012, not November 2013, November 2012. At that time, we reached zero lower bound. It's 4 years ago. Just, recall what kind of economic conditions we saw in the whole world in 2012. Just recall it. And CNB is here to provide something like a monetary condition index. Monetary condition index consists of both, I would say, tools. interest rates as well as exchange rate. Nevertheless, back to November 2012 and later on November 2013, at that time, just recall what kind of real economic we saw at that time. At that time, there was a significant trend that the headline inflation went to deflation. There was no, real demand. At that time, we had the longest recession in the history. So why I'm saying that? Because there is no doubt that FX commitment has, helped to change the condition. I just mentioned that if you look at the core inflation, it's completely in a different situation. Real economic situation is a completely different situations. And you just mentioned that governor yesterday, you said that he put nominal interest rates more to the financial market. I'm just trying to say that if we really try to put together, exchange rate, interest rates, and financial market, well, how to put it together? You have to think about uncovering interest rate parity. And back to what I said at the beginning, look what kind of interest rate differential we saw in November 2012. So there was no doubt that, if we wanted to change the whole economic environment in 2012 and 2013, our most effective way was to use exchange rate commitment. Now, if we are talking about, not real economic situation, but about more financial markets, I think it makes sense to look what kind of monetary conditions in the surrounding areas we see. And Tomáš, he ended his presentations regarding that we also have to look what's going on in our more important trade partners, which is Eurozone. And definitely, there was clearly announced that the program will continue till March 2017. Yeah, and probably it can be significantly enlarged. So again, it brings me back to our model. Our model heavily relies on uncovering interest rate parity. And if we see that one variable, which is interest rate differential, is going to be widened, we have to think how to really mitigate it. So there was a serious debate about introducing of negative interest rates, but it's not due to we have to change our, I would say, the whole monetary condition index as a whole, because we still see two things. If we need to change the whole real economic situation, FX commitment is the best thing to do that. The second one is there is no limit. But if we want to really more focus regarding the financial market, it's a way to think about it. Thank you.
Thank you. Any other questions, please? Mr. Sobíšek?
Yeah.
Pavel Sobíšek, UniCredit. Let me continue on asking about the negative interest rate. Can you deny that the issue of imposing the interest rate was voted about yesterday? Thank you.
The first question, second one was from Komerční banka, so go ahead.
Marek Dřímal, Komerční banka. Can you please elaborate more on what kind of instruments or securities are you watching in terms of financial markets and their differential, interest rate differential? Thank you.
Okay, two questions we do have. Do we have one more in the third round? No. Okay, so let me start with the question which was quite clear. And, we are honest and we are transparent central bank, so we don't lie. Why I'm saying that? Because we publicly announce not only whether we vote or not, but also the names, casting names, And yesterday there was no vote regarding negative interest. There was serious discussions, serious debate, but no vote. We voted. Our rules that we vote but we mostly vote on I would say, proposals provided by the department, monetary policy department, which is based on model-based forecast. And this model-based forecast is based at the technical zero interest rates. Yeah? So there was no vote. But as I said, it doesn't mean that we should rule it out. Regarding the second question, it seems to me it's more technical issues. What kind of financial instruments we really imply in our forecast? And I'm pretty sure that Tomáš is the right person to answer. Tomáš, help me.
It was about what particular interest rate differentials. Okay, well, in terms of the model as such, it's mainly the interest rate differential between 3 months PRIBOR and 3 months Euribor. But, well, we are using also a kind of shadow Euribor concept, which tries to reflect the fact that quantitative easing is ongoing in the in the euro area, and we estimate that the impact of this QE is at least 1 percentage point. So the shadow interest rate is really in more negative territory than the actual one. We had a publication on the shadow interest rate concept in our Global Economic Outlook publication, which is available on our webpage, so you can have a look at it. But I think when the board was mentioning the interest rate differentials in its statement, they had a broader view than just the representation of the interest rate differential in our forecasting model. In particular, the reason why the board did not feel any big pressure about discussing negative interest rates in November and December last year, it was the fact that market was in a sense working on behalf of us, and the relevant segments of the financial markets were having significantly negative yields, even though the policy rates remained at the technical zero level, which means marginally positive. And this was, in a sense, a reflection of some market imperfections, suggesting that perfect arbitrage is not taking place in the financial markets. But according to information that we are getting now, both from the market pricing and from our trading department, it seems that some of the obstacles to that arbitrage are now lessening. So the argument the market is working on behalf of us is becoming less relevant, and of course, given the interest rate differential and the fact that the volatility of the exchange rate is now very low, both at de facto and as implied by market options, of course, you have to think whether such an interest rate differential is not a kind of invitation to credit trades and things like that.
Thank you. Next question. Once again, please.
Yeah, one more. The tightening of basis swaps, that perhaps was one of the reasons behind the discussion you had, was partly due to the heavy issuance on part of the Ministry of Finance in the beginning of this year and in the last months of 2015 that utilized negative basis swaps, introduced or an increased demand from foreign investors. Is there any discussion with the Ministry of Finance that perhaps they can curb this huge supply that is in effect widening the interest rate differential? Thank you.
Okay, so it's, the first questions in the fourth round. I think we do have fourth round of questions. Is there any other questions or not? I don't see. Okay, so let me take this. Let me take the questions. First of all, we can just speculate what was really behind, the negative swaps, It can be one of the reasons you mentioned, but that's, hypothesis. So I think it makes sense to mostly deal with the second part of your questions, whether there was any discussion between CNB and the Ministry of Finance. First of all, if there were any discussions like that, I don't have any mandate to, disclose it, honestly. What I can only say that, we both, institutions, we cooperate and we try to do, our best, definitely, to help this economy. Our mandate is to deliver price stability. If it's not in danger, we are here to support the economic growth, yeah? So this is only what I can say. And the cooperation between the CNB and Ministry of Finance has been working very efficiently, not only, in the field of monetary policy and economic discussions. And as you know, I'm responsible for supervision. And so, well, mostly what I can say, it has been working very well in the whole supervision, regulation, etc. Thank you for your question. Is there any other questions? It's almost 5 minutes to 12. In the previous or in the latest round, there was only one question. If we don't have any questions, it seems to me that there are presentations and forecasts published yesterday, and the summary of inflation report published in the morning, yeah? Was clear enough? If I see there is no questions. So let me thank you very much for, coming for this meeting, for your questions, and especially for your interest in the monetary policy of the Czech National Bank. And I'm very pleased to see you next time in next 3 months.
Yes.
Yeah. Thank you. Thank you.
Thank you. Bye.